For India's equity market investors, the last few sessions have been a roller coaster ride. Look at what happened on Monday, May the 13th. The BSE Sensex eventually closed up 112 points, but interestingly, there was almost a 1,000 point swing between the day's low and the day's high of the benchmark index. The BSE mid cap index closed up, but the small cap closed down. That is the kind of volatility investors have seen over the last few sessions. Now, if we see the returns that equity markets have delivered so far in 2024, the Sensex is up about 1%. The mid cap has delivered close to 12% returns, and the small cap is also up over 6%. And this is on top of the rally that we saw in 2023-24, when the Sensex and Nifty 50 were up 25%, while the small and mid cap indexes jumped over 60%. So, what is driving the volatility and the nervousness among investors right now? Well, one is the ongoing Lok Sabha elections. Initially, it was expected that the Narendra Modi government will easily win a third term in the Lok Sabha. But the lower voter turnout that we have seen in the initial few phases of polling has led to worries that it may not be an easy victory for Narendra Modi after all. The high valuations that prevail in Indian stock markets after last year's rally are another reason why markets are volatile, and a lot of foreign institutional investors have pulled out money from India's stock markets, one because of valuations, then the uncertainty around elections, and the global geopolitical turmoil, be it the war in Ukraine or the tensions in the Middle East. In May alone, foreign portfolio investors have pulled out close to 18,000 crore from India's stock markets. Overall, in 2024, thus far, foreign portfolio investors have pulled out 16,000 crore from equity markets. When the world is in a turmoil, a safe haven asset like gold does very well. So far this year, it has given 13% returns, and that is also driving a lot of investor interest from equities to gold. That is another reason why markets are volatile. Then there is stock specific activity that has also had a bearing on the broader markets. On Monday, for instance, shares of Tata Motors plunged. While the company did report strong earnings for the fourth quarter, that is the Jan March quarter, a muted outlook for the current financial year had investors worried, and that led to the sharp fall in the stock price. Now, what do analysts say at this point of time on market volatility, and how should investors look at Indian markets? Well, Bernstein analysts say the market's reception to the ongoing elections reveals some nervousness and a kind of fatigue. But a weak voter turnout should not necessarily cause a big concern. The Bernstein analysts say it will take a lot more than just a drop in vote percentage for the BJP tally to be significantly dented, and India Inc. to start factoring in a case of non continuity. Based on their assumptions, a 2 to 3% decline in voters along with anti incumbency will likely lead to figures for the BJP just below the 2014 tally. What's also notable is that India has net added nearly 60 million voters between 2019 and 2024. So while the percentage in voting may decline, there may yet be an increase in the absolute number, say the analysts at Bernstein. Unless we witness both the voter turnout witnessing a steep decline and a significant anti-incumbency contributing, we don't see much impact in the overall election results, with the incumbent party expected to sail through, is what they say. On the valuation front, of course, markets are not looking too attractive, but HDFC Securities' MD and CEO Dheeraj really says valuations are not at euphoric levels either. India will remain among the fastest growing economy this year, and that will continue to drive the momentum, he says. While the global funds positioning in India's stock market remains light, investors may use any corrections arising out of the elections as an opportunity to increase their holdings, he adds. Now, we recently also interviewed Nilesh Surana, the Chief Investment Officer of Mire Asset Investment Managers. He also pointed out that barring a few pockets or a few sectors, markets were not very expensive at this point in time. He pointed that when markets had moved so fast, there was bound to be some near term consolidation. His advice to investors: look at a 3 to 5 year horizon, stagger their investments, and instead of putting lump sum right now, is what his advice is.